Hello again. Welcome to another episode of the Uranium Market Minute. Today is Monday, November 22nd, and this is episode number 40. My name is Justin Hune, and I am your host and the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for tuning in today. I really appreciate it. Before we get into it, of course, nothing in this video is meant to be investing advice. I'm not your financial advisor, and this is not financial advice. Please always do your own due diligence when it comes to investing and always take responsibility for your own choices. Another exciting day in the world of uranium. Let's jump right into the daily scoreboard here. Spot price of uranium trickling down another quarter or so, 46.25 per pound mid-market, drifting down a bit. There's a little bit of volume happening on Friday. Sprott did buy 200,000 pounds on Friday. However, they did not issue any new shares and raise any money on Friday, as they were likely at less than that 1% premium to their net asset value throughout the trading day. They closed the day on Friday at 2.76% discount to NAV. They are likely right around that, maybe even a bit more, maybe 3 to 4% discount to NAV here, as the spot market is relatively stable and the trust is selling off a bit today with some broad selling across the sector. Their treasury stands at 50.5 million in cash as of Friday's close, enough to purchase over another 1 million pounds of uranium. Since the 17th of August, when their ATM went live, they've raised almost $1 billion, 992.8 million of new capital. That besides what's sitting in cash now, 50.5 million has all gone to purchase physical uranium. Just under $1 billion, incredible. They purchased 21.5 million total pounds of uranium. So just so you know, the entity that Sprott took over, Uranium Participation Corporation, when they were trading at a significant discount to the net asset value for a long enough period of time, they would actually sell physical pounds of uranium, raise some cash, and buy back shares. That is not something that the Sprott Physical Uranium Trust is doing. Essentially, what they are doing is they are steadily and consistently issuing shares when they're at north of a 1% premium to NAV and buying physical uranium, as we all know, not only because that's their stated purpose, but also that's the messaging to the market, right? The messaging is capital comes into this thing, we're going to do what we said we're going to do and buy pounds. That was a big difference between Sprott and UPC. UPC traded at big premiums to NAV for extended periods of time without purchasing anything. And so these moments of a discount to net asset value for the Sprott Physical Uranium Trust are essentially arbitrage opportunities for investors. And so what we've seen since the launch of the ATM, which is about 3.5 months now, we've seen that the moments that they are at a discount to NAV are fleeting. We're seeing 1 or 2 days, 3 days. I think the longest period of time that they were at a discount to NAV was maybe 5 or 6 trading days. And so now we're at 2 or 3 days of discount to NAV. And most of the time so far, what's happened is investors take advantage of that opportunity before it gets too steep of a discount to NAV, because that's a quick trade. If you believe that the spot market is going to remain stable, if not move higher, and they're trading at a 5% discount to NAV, you can make a quick 5 to 10% just on the arbitrage of the discount to premium to NAV. So that's how the Sprott vehicle functions relative to UPC. And these moments where they're at a discount to NAV since August have been not only buying opportunities for that vehicle, but for the sector as a whole. That's something that you can go ahead and look back over the last few months and see that that's the case. Looking at the sector equity ETFs, on Friday, URA reported 130,000 shares in redemptions. URNM reported no change. That's about 2.5 million in mandated selling from URA. The AUMs of the two trusts did drop by about 84 million on Friday due to the selling in the sector, primarily due to the selling in the sector, not necessarily from the redemptions, which there was a bit of redemptions for URA, like I mentioned. The two ETFs still have a combined assets under management in excess of 2.3 billion. Even after the recent weakness, they've had an increase of 172.8 million since the month end of October. Let's go ahead and take a look at the charts. Starting off as we always do with URA, seeing another pretty big selling day. We saw a couple of big selling days at the beginning of last week. It started to stabilize. Friday, the sellers were back in the driver's seat, and that's following through today with it trading with another hour of trading to go near the low of the day. Not very pretty looking. However, we are still at a slight higher low from the previous low that was a month ago. And I would love to see this close higher than this $25.98, $26 range. We're at $26.40 here. However, this could be just a bit of a false breakdown here. In my opinion, we're still going to be trading above this rising 200-day moving average, like we saw this fake out breakdown below the 200-day right at the perfect bottom of the market before it absolutely exploded with Sprott. Volumes are still they're reasonable, right? They're not huge, they're not nothing. This is right in there. However, indicators are showing me that we could see another couple of days like this. That is possible. And what happens with these redemptions, so the redemptions that were reported on Friday, that likely was part of the selling on Friday. I wouldn't be surprised to see more redemptions today from URA and URNM, and that's probably what's affecting the bulk of the sector is ETF outflows. However, these are not volumes that are scary. This looks like sellers are just in control here. The Sprott Physical Uranium Trust, I'm seeing another higher low here. In my opinion, this is a screaming buy at a 4 to 5% discount to their net asset value. Not a lot of volume here. We know that we've seen the big volumes when the market understands that it's time for that cycle to revert, and it's time, and they are trading at a premium to NAV, because then the market knows, okay, my money coming into this trust will lead to physical purchasing. Taking a look at Cameco, holding up better than the ETFs for the most part. Still not huge volumes here. In my opinion, this still is a correction, a pullback in an uptrend, right? And so you're really going to need to get used to these things. If you're in this market for the long term, these pullbacks to the 50-day, a little bit past the 50-day, we will get, numerous pullbacks to the 200-day during this bull market, and these corrections are going to continue to happen. So I know that they don't feel good to see red on the screen, and it always feels better to see green on the screen. But if you are still positioning, or you're wanting to add based on conviction in the sector, which for me is extremely high, these pullbacks are excellent opportunities. And again, I talked a lot about this last week. I don't remember if it was the last episode, episode 39 on Friday, but investing psychology and how your emotional instinct when you see selling on the screen is to run for the hills and to sell because you think it's going to go lower, and maybe it will. But really what you want to be doing is the opposite of what your emotional reaction is. So the last week or so that we've had selling, I've been adding to positions personally, and which I did today as well. And these are big opportunities because the conviction is just extremely high, like I mentioned, and everything is lining up fundamentally for this sector to run. I still believe that we will see a bottom here soon. I think that the selling is mostly done. Maybe we'll see half of this week, another couple of days of selling, but I believe at some point throughout this week, we will find that bottom and we will reverse course and resume this this uptrend that we're currently in for the uranium sector. Taking a look at the mailbag, this question comes from John, John R. He asks, Justin, I keep hearing about the carry trade. Can you explain to me what that's all about? Yeah, thanks, John. The carry trade is a really interesting phenomenon. In the uranium market, it's been a major player, a major impact to the market in multiple ways. Essentially what it is the uranium traders will contract with the utility to promise the delivery of pounds at some future date, and they will actually carry those pounds and carry the liability and the risk along with adding some profit. So for example, let's say utility wants to buy 1 million pounds of uranium for delivery in 2023. And the price of uranium currently in spot market is $46 a pound. A trader might promise that delivery in 2023 for $49 a pound. Then they will purchase the pounds in the spot market or off market, but a lot of times it's in the spot market, and they will hold those pounds and they will carry them and deliver them out in the future. Now, why would a utility be doing this instead of contracting with a producer? Well, for up until now, with current spot prices, starting to get into that range where mines that are on care and maintenance, need these types of prices and higher in order to start to fill those contract books to de-risk their assets and eventually bring those back online. Let's say 2 years ago, we had a spot price at $26 a pound, a term price at $29 a pound. And Cameco is saying, yeah, guys, we're not bringing McArthur back online until we fill this book with $45 to $55 a pound uranium. So you're a utility, you can go to a carry trader and say, I want, 2 million pounds delivered to me in 3 years from now at a slight premium to the existing spot price. And the carry trader would oblige because they can buy that material freely in the spot market, because there was a lot of liquidity in the spot market and a lot of standing inventory that came from the excess supply from the previous decade. So if you're a utility and you need to cover, a couple of years out, why would you go ahead and voluntarily sign contracts at prices that are 50, 60% higher than the existing price, 70% higher than the existing price in the market, simply to satisfy the producers, when you can just buy that uranium and have it delivered in the carry trade? Carry traders got kind of a bad name, at least from the investing side of things, because the investors are upset that the utilities haven't come to the table sooner to voluntarily pay these higher prices with the producers that have mines on care and maintenance. And so with that said, the carry trade has really done a lot to clear out that excess inventory that came from that overproduction from the previous decade. So it really, it was one of those functions that the market sort of brought to life, and it served a great purpose, and to some extent still does. Now, we believe that the amount of pounds that are being contracted, let's say, with carry traders currently is drastically declining. And the reasoning for that is that the price volatility is so great in the uranium market, right? You're seeing big swings in the spot price of uranium. It's much more difficult for a carry trader to promise delivery of pounds, out into the future, just a few dollars higher than it's currently trading. Who knows what the price will be at the time? However, if they can cover those pounds now and still make a bit of a profit on it, they'll do it. So it's more than likely it's continuing to happen, although we believe that the volumes that we're seeing in the previous few years are much, much lower, much lower now than they were then. And so, yeah, essentially that's how it works. And this happened a lot in previous years. And it's really something that kept the producers from being able to sign contracts with the utilities. And it's not really, only the existence of the carry trade. It really has to do with the surplus. It's not, the carry traders are not necessarily to blame for this. It's the existence of the surplus, would find its way through the market somehow to the utilities that were in need of pounds. But really the most important thing to understand with all of this is that seeing the price move in the spot market and in the term market, by the way, which continues to move up and made its biggest jump in the last 10 years last month. The market is turning into a seller's market. Okay, this has been a buyer's market for 10 years, and it's slowly turning into a seller's market. What that means is the producers are starting to see more interest from utilities, and the existence of the Sprott Physical Uranium Trust, along with other funds and other players, traders and utilities coming into the market, purchasing, a few years out with carry trades, purchasing on the spot market. The turn in the market is slowly happening, and it's happening now. And every pound that Sprott purchases from the market is a positive for the uranium market, okay? When it comes to the investment thesis. So if you are concerned that Sprott is purchasing these pounds and the spot market isn't moving very much, I would say belay that concern and understand that if they're purchasing pounds currently and it's not moving the market, what it's doing is it's removing pounds that would have been available in the future. I've made this analogy in one of the previous episodes where, and I made this, I'm sorry, it was in a tweet. It was a tweet thread last weekend, I believe. The analogy was that Sprott is a boat that is motoring away from a pier. It's accidentally still attached to the pier with a rope tied to its hull and tied to the pier, and the rope is coiled in a giant coil on the pier. Nobody knows really how long the rope is because the coil is just a mess on the pier, and the boat continues to motor away from the pier. Okay, at some point that rope is going to run out, and that coil is going to pull taut, and the boat is going to yank the pier into the sea. And how fast and how far that boat goes is based on the fuel load, and the fuel load is going to be investing capital. So as investing capital continues to flow into this vehicle, into this boat, it's going to continue to pull uranium out of the market and pull the rope out of that coil. And it will get to a point where the uranium does essentially not dry up, all right? There's always production. It's always production coming into the spot market. It won't dry up. But what will happen will be the investing capital driven purchases of physical uranium will outpace not only what is produced into the market, but what is being sold into the market from inventories, from something called a reverse carry trade, by which I'm not going to get into right now. If you want to learn more about that, please download and read the latest blog post from Sager Capital. It's really a fantastic piece, and I highly suggest that you read it. Go to Art Hyde's Twitter page. There'll be a link in it, and I retweeted it, and so did everybody else, because it's really well done. So the only thing really to understand from the reverse carry trade that I'll mention right now is that pounds that are to be delivered out into the future are being sold to Sprott now, and the pounds that are going to fill those contracts from a carry trader are coming from a producer, and those pounds would have been available to utilities 2, 3, 4 years down the road. And now what they're doing is they're going to fulfill the demand of that reverse carry trade. I know it's complicated. Like I said, I'm not going to get into it now. What that means is there's pounds that are coming into the spot market or being sold to Sprott, let's say, that are not from primary production coming into the market right now. They are future production. And basically what that means is not only is the existing spot market relatively thin, to the point where when Sprott comes in heavy to the spot market, you see the price move. We've already seen that on numerous occasions. But to be able to purchase pounds that would have been available to utilities means that there's going to be a come to Jesus moment. And that is going to happen within the next couple of years, in my opinion, where utilities will recognize, okay, this is actually for real. This Sprott thing isn't a flash in the pan. We're not just going to sit this out and hopefully go back to a uranium market in the 30s, and they're actually getting messaging coming from nuclear fuel consultants letting them know as such. Don't expect the market to go back down to where it was, possibly ever. And when the utilities do finally come back to the plate and start to look for those pounds, 2023, 2024, 2025, and beyond, even smaller volumes, they're not going to find them, or they will find them in less availability than they would have if the carry traders weren't selling some of the pounds they were carrying to Sprott. So that's kind of a very opaque way to describe it. Like I said, if you want to understand this better, read Art Hyde's piece. It's really brilliant. In fact, you know what? I'll go ahead and link to it in the show description. I'm going to stop that there because that is really a rabbit hole. But basically, long story short, Sprott purchasing pounds is a fantastic thing to happen to this uranium thesis. And if you're doubting things in the short term because the price isn't moving and Sprott's buying all these pounds, know that they're buying pounds from present day producers. They're buying inventory that's sitting in the spot market. They're buying pounds that are being sold from entities that need to deliver those pounds in the future. All right, so that's pounds that are coming away from utilities. I'm going to leave it there, guys. That's a lot to cover. So I will see you guys tomorrow. It's a short week. It's Thanksgiving week. We're going to be on for 3 days this week. And I want to remind everybody that the webinar that we did last week for members, that is up on the website. If you did not attend live, you can watch that streaming from our website. If you are a new member or would like to join, you can immediately view that members webinar where we went deep into all the companies that we own and recommend, deep into the sector. We had some special guests on, the CEO and the board chair of one of the companies that we own and recommend. That was a great discussion. I'd also like to remind you that on December 1st, we will be raising our prices by $200. Anyone who subscribes between now and then or before the 1st, you will lock in the current rate for as long as you want to be a member, and we would love to have you. If you'd like to see a sample of our content, please click the link in the show notes, and you will be able to download a sample of a previous month's newsletter, get an idea about the type of content we put out. All right, everybody, hang in there. Pullbacks are healthy. They are normal. They will happen a lot. Just take a deep breath, understand that this is training, okay? This is training for what you're going to experience in this market, because it is going to be wild, the upside and the downside. This will happen many, many times over the next few years, and just get used to it, take advantage of it. If you want to increase your exposure, trade in opposite of your emotional instinct, and have a great evening. Cheers.